Hey there. Happy Friday. It's April 14th. I'm Dave Keller here at StockCharts.com. Today on the final bar, we will wrap this week. We'll focus on what we've learned through the course of the week. Kind of a choppy day again today. Overall, the major averages finishing slightly lower. We'll look at what we learned through the course of this week. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com, coming to you for the last time for now from the Columbia River Gorge here in Oregon. Appreciate you hanging with us this week as we do the show remotely. Our team back in Redmond is doing a really fantastic job helping this seem like this is easy to do. And I really appreciate you guys tuning in for the week. You know, as we look at the markets through the course of today, and then along with the previous 4 days, we have to think about sort of the overall conditions. A lot of the conversations I've had with guests this week are sort of about this conflict or this juxtaposition between some very encouraging signs and some very discouraging signs, right? Signs looking at macroeconomic data, looking at the Fed, looking at recessionary pressures. My conversation with Tony Dwyer comes to mind last week. A little bit cautionary, right? Thinking about the downside potential if the market would sort of embrace the conditions that seem to be very apparent when you look at some of the data. On the other hand, you can't help but notice that the trends overall are positive. Breadth conditions aren't horrible. They're either pretty good or kind of good, right? But they're not bad by most stretches. As a matter of fact, we've actually had some buy signals from indicators like the Zweig breadth thrust, which occurred about a week or two ago. The Kopic curve, which turned positive a couple months ago. My market trend model is bullish on all three timeframes still on Friday. So, we see conditions suggesting market strength. Days like today, where you have banks popping higher on earnings, gives a little bit of optimism, I think, about the upside potential for stocks. But at the end of the day, the most important thing is to watch the trends on the charts of interest, particularly the major averages. And while they are strong, while they are improving, they're not quite breaking out yet. And I think that's what differentiates a raging bull market from a kind of encouraging market. Let's go through a lot of those charts together here in our market recap as we wrap the week. I do want to start with a poll. We always have a poll going on our live stream page at StockCharts.com, also on our social media accounts. So follow us on Twitter. Make sure you subscribe to our YouTube channel. We asked you recently, which of the Americans performs best over the next 3 months? American Airlines, American Express, American International Group, or AIG, or American Eagle Outfitters, AEO. This actually came from the Fidelity chart room years ago. They had a chart called the Generals. It was General Electric, General Motors, General Reinsurance, and a bunch of General Mills, a bunch of these other stocks with General in the name, these big industrial kind of stocks. And the idea was to track their performance as just an overall market indicator. So I think it's fun to pick a theme like American or National or General and just see what we think. And it just gives you an opportunity to look at 4 different stocks and compare and contrast. And I would argue that technical analysis is so ideal for that sort of comparative analysis. And I know this from having worked with fundamental analysts for years and years. Looking at a company like American Airlines, if you're a fundamental analyst at a big investment shop, you know the airlines intimately well. You know the companies, you know the management, you know all the supply and demand factors, and you probably have a good sense of this particular stock. But you're not particularly well equipped to compare American Airlines, which is testing the lows, to American Express, which is making a much higher low above its 200-day moving average. Compare that to AIG in the financial sector, again, bouncing off the lows similar to American Airlines. And then AEO, which is American Eagle Outfitters, also above its 200-day. So, comparing these 4 charts just very briefly, and I've not looked at them too closely, but I would probably agree with about half of you that said American Express, and I'll tell you why. I immediately would focus on the 2 charts above their 200-day moving average. That means AAL and AIG are off the list. We're left with American Express and American Eagle. What strikes me about the chart of American Eagle is you have this bearish engulfing pattern, December into February, pulling back to the 200-day, which is encouraging, but overall, that's sort of a distributive kind of topping pattern, I guess, to the entire feel of it. American Express is a little less like that, right? You didn't really have much of a topping pattern. Certainly had a pullback to its 200-day moving average, but holding in there okay. Charts like this, none of these four charts, I would argue, are incredibly bullish at the moment. But in terms of comparative analysis, it's all about the strongest to the weakest. I would agree this is probably the strongest of the four. If I had to place a bet, I'd probably look at this as a potential idea. On a lot of these charts, by the way, I'm thinking about my conversation with Mark Newton this week. Thinking about trend lines off of the lows can be a very simple but super powerful technique to just make sure you stay with the trend that's working and have some sort of signal, some level, some break that convinces you that you might want to revisit that position. I think a trend line off the lows on AXP might be a real good idea for sure. Let's look at what happened through the course of the week. We're going to look at what I call the wrap the week chart, which just looks at 5 major asset classes. Actually, a couple more. Looks at a couple other ones. Got to have Bitcoin in there as well. We're starting the clock last Thursday, actually. So this is Thursday's close on April 6th. We're then looking at the 5 trading days this week. What did we learn about these markets? So the S&P finished the week up 0.8%. You can see a couple things outperform the S&P. In orange, emerging markets, almost the same. We'll call it a wash at 0.8%. 1.5% higher, that's small caps. In red, we have that's not bond prices. That's actually, crude oil up 2.6%. Up in the top, we have Bitcoin with a decent week, up 8.2%, handily outperforming the rest of these. And we highlighted the chart of GBTC. I think that was yesterday, the day before, as part of our 3 and 3. I've talked about Bitcoin often in the media. I'm often asked about it. Julius de Kempener does a lot of media outreach for us in the crypto space and has often come up. And I certainly the interest in our perspectives on cryptocurrencies have certainly flourished while these assets have flourished as well. Bitcoin moving higher in an impressive week. Ether getting above 2,000 is a meaningful threshold to get above. So I'm impressed with what I'm seeing, and I think there's certainly some further upside potential in some of those charts that are working. Now, what underperformed the S&P this week? A couple of things here. We have the NASDAQ 100, which is essentially flat, up about 0.2%. Gold, essentially flat for the week as well. The dollar index, not too far below zero as well, down 0.2%. The worst performer this week is actually the TLT. This is bond prices down 3.2%. Through the course of the week. It's interesting looking at the TLT. We talked recently about how close it was to breaking out. It actually has not played out that way. Let's look quickly just at the chart of the TLT, and then we'll go through some of the other benchmarks and what they did through the course of the day today. Here's my main chart of the TLT, and what's so interesting about the chart of bond prices, similar to the chart of equity prices, I would argue that if given the option between bullish, bearish, or neutral, not based on my projections of what's to come, but just my evaluation of the trend, how would you define what you've seen over the last 3 to 6 months in each of those? I think the easiest and most intellectually honest answer is sideways across the board. Bonds are in a sideways trend, and I will tell you that because we have resistance around 108. We have support around 98, 99, we'll call it, on the TLT. We're range bound, right? We literally have gone back and forth between those support and resistance levels for quite some time. Now, if you forced me to pick bullish or bearish, I would probably say bullish on the fact that we've finally broken above the 200-day moving average. And for now, even though we barely did it today, for now, we're holding that. But if I look at the trend and just try to draw lines or ways to capture the direction of the trend, I'm most struck by this sideways rectangle kind of pattern. As we mentioned earlier this week, I forget what chart it was. Anytime you can just draw a big rectangle around the price action, that tells you the trend is sideways. Also look at the momentum characteristics, right? In bullish phases, the trend in momentum tends to get a little higher than normal. In bearish phases, it tends to get a little lower than normal. You can see through much of 2022, the RSI rarely got above 60, often became oversold, which is more classic of a bear market phase. Look at what it's been year to date. The RSI has gotten neither above 60 with much success or below 40. It's kind of right in that neutral range. And again, that tells me pretty much most of what I think I need to know about the trend in bonds. Sideways. Now, that's not to say that they can't break out. I'm just saying I haven't seen enough yet to give a clear buy or sell signal based on a breakout, a follow through of those trends. Same can be said for the S&P. And we'll look at that chart here in a minute. We saw the weekly returns and what happened over time. Let's just check in briefly on what happened today. Overall, more of a distribution day than anything, I would say, to generalize, but there were certainly some areas of the market popping higher. Financial, certainly the upside outlier today. A number of banks reported earnings, including JP Morgan, Citigroup, Bank of America, PNC. There's some regional banks in there, and that continues really into next week as we sort of get into the meat of this first earnings season, really the second one of 2023. But as we're looking at the benchmark returns, the S&P down 0.2% to 4138, a little bit below there. The NASDAQ composite up about 1/3%. Mid caps and small caps underperform the S&P as well. And small caps, the worst performing of the group. I posted a YouTube video earlier today on my Market Misbehavior YouTube channel called 5 Measures of Market Conditions. One of the things we focused on a little bit was the performance of small caps and mid caps. I'd encourage you to check out that video because some interesting, concerning movements in small caps, just telling you it's not very much of a risk on feel to the market. And I think that's, again, when I think about what concerns me, why I'm not just overly optimistic based on positive signals that I've seen, it's because of the lack of participation in areas of the market that I would expect to do very well. Something like small caps or mid caps probably come to mind. Elsewhere, the VIX moved lower. We highlighted that chart yesterday. The VIX is almost below 17, which would be the first time it's gotten that low, I believe, since 2021. We had sort of that extended up period on low volatility. Look at the VIX in April of 2023 versus the VIX of April of 2021. You will find a similar theme in volatility, which was a period of elevated volatility becoming a little more muted. You're seeing the same thing today with the VIX as well. Quickly elsewhere, the yield curve overall moved higher, sort of across the board, and the midpoint, sort of that 10-year, 5-year, 10-year point, moving higher, probably the most. 10-year yield just above 3.5% to 352 today. The dollar index up as well, and bond prices, as we mentioned, going lower. Gold and silver pushing lower as well. A number of my guests recently have talked about gold. Talked with Ms. Schneider about that on the show this week. Mark Newton, we talked about silver. Really two great perspectives on those markets. And I agree with their take on the long-term potential there today, giving back some of those recent gains. Cryptocurrencies, a little bit mixed, but overall, I would still say netting positive. Ether prices just getting above 2,100 earlier today, just below it as we're going live with the show here. But again, just a strong performance still from cryptocurrencies. Talk about a sign of strength in a very speculative asset. The fact that Bitcoin's above 30,000 and Ether's above 2,000, those are both pretty decent charts to highlight. Just to finish off, I mentioned financials, the number one sector. And to wrap up our Wrap the Week segment, I would point out the great thing about the chart of JP Morgan, it has now bounced off of the 200-day moving average, gapped above the 50-day today, but not yet above its February peak. Same can be said for Citigroup and a lot of other financial stocks as well. So I like the short-term bounce in the banks. That can't be a bad thing, and certainly suggested that concerns about the financial crisis are probably behind us, according to what I was hearing going through some of the transcripts. However, I would feel much better on a chart like JPM if it could get above 142.50, make a new swing high for the year. Then we can talk about renewed strength in the financial sector. Let's take a quick break and then we'll come back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to bring you the show every weekday after the close. I'm excited to get home, get back into the studio beginning of next week, and keep bringing great content, some really good conversations with you. A couple quick announcements before we continue on with today's show. First off, we're going to do a mailbag segment a little later in today's show here in a few moments. We're featuring questions from people like you over the last couple of days. Keep the questions coming. We'll do another mailbag on Monday's show, and we'd love to answer your question live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to answer your question live on the air on Monday's show. Upcoming guests, boy, we've had some really good discussions recently, and I'm so appreciative and thankful of these great market traders and strategists and analysts sharing their time with us. Next week, Tuesday the 18th, Ari Wald of Oppenheimer, one of the best. Wednesday, April 19th, Craig Johnson from Piper Sandler, a technical analyst that I've known for many, many years. Then on Thursday, April 20th, Dan Russo from Potomac Funds is going to be joining us. Dan actually used to host a show on StockCharts TV every week. I have missed seeing his face and getting his perspectives on our channel. I'm looking forward to getting him on the show next week. Also, to let you know, I will be doing my next free webcast with Market Misbehavior coming up next week. That's on Tuesday, April 18th, 1 o'clock Eastern. The session will be called 3 Steps to Every Signal. I'm often sent a chart and people ask me, what do I do, right? When do I take action? How do I interpret it? And what I always reply to them is some version of what I'm going to present in this webcast, which is there are actually 3 parts to the signal. A signal is not just a moment, it's a process with 3 individual steps. We'll talk about the setup, the confirmation, and the follow-through of the exit strategy, and why each of those are independent but related, and how to trade around those for technical indicators that you follow. To sign up for that free event, by the way, go to marketmisbehavior.com/3steps. Let's continue on our show today with the final bar mailbag. Please keep your great questions coming. And let's get to our first question here today. Dave, I sometimes hear presenters talk about candlesticks, but don't see many using them. How valid is the concept for stock trading rather than rice trading? I love your question. And you're hitting on the history of Japanese candlesticks. What's so interesting, as a technical analyst now 23 years and counting into my career, I've spent a lot of time talking with earlier practitioners that have come before me from generations ago. And getting an opportunity to pick their brain about how how the practice has evolved over time. And Japanese candlesticks are actually one of the earliest forms of technical analysis that we still use. What's interesting about candlestick analysis, it is so relevant today relative to what it was when it was created, which was, as you implied, for rice traders in Japan back in the 1600s. So candlestick analysis, I would say, still very much important. And I've made a note a while ago to try to incorporate more candles into the show, which is why I often bring up a chart that looks kind of like the one I'm showing you here, which is a candle chart of JP Morgan. I don't show candles all the time, but I like to reflect on key patterns when they emerge. What's great about candlestick analysis is it is very visual. So if I had a shorter time frame, if I was more of a swing trader looking out a couple days to a week at most, I would use candlesticks way more often than I do, because I would argue that they are one of the best ways of illustrating short-term shifts in sentiment. An example of that is when JP Morgan traded down to its 200-day moving average in red. And look at this candle pattern right here that is called a hammer candle, where you have an open, you trade lower, you close back higher, and the open and close are near the upper end of the range with this long lower shadow. That represents short-term positive sentiment. And what it basically illustrates is that we traded below the 200-day moving average during the day, but buyers were recognizing that and buying in on the short-term weakness and literally provided the support you might expect as a long-term investor. That's how the short-term candle charts show you the relationship between the day-to-day movements in the market and some of the long-term signals you might be thinking about, like moving averages and support and resistance levels. So I very much use them, and when I'm looking at shorter term timeframes, daily and even looking at a couple days to a week, I always use candle charts for that reason. Probably if we featured more swing traders on the channel, they'd bring a lot more candles with them. We're looking at a lot of longer term charts where candle and bar charts are probably interchangeable. So I've just learned to use bar charts. However, I would say for stock trading, for short term analysis, essential, and I would argue that they are very much relevant, as relevant today as they have ever been. Great question there, by the way, and thank you. Next question, is Tesla a cup and handle on a cup and handle, which is not an official pattern that I know of. So we'll call it a newly created multi-cup and handle pattern, or whatever we want to call it. Is this a cup and handle on a cup and handle? So the problem is you didn't send a chart with you, so I'm not 100% sure which double embedded cup and handle we're talking about. So let me see if I can maybe back into what you may be talking about. If we're looking at the last year, I'm guessing maybe what you're thinking is this is a cup with a little handle. Not perfect, and I'll tell you why, but I see what you're looking at. And then maybe this is another little cup and handle, or maybe one of these. I'm guessing that's what you're talking about. And if this was your question, send me shoot me an email, thefinalbar@stockcharts.com, and share with me a chart that illustrates exactly what you're looking at. I'd love to dig into it a little further. None of this on Tesla's chart, though, is a great cup and handle pattern. I'll tell you why. A cup and handle, literally look at the chart and think about what would happen if you poured coffee into your cup, right? So what would happen here? Well, the problem is the left rim is up here, the right rim is down here. And a cup and handle pattern literally should be fairly consistent. So the left edge of the cup, the right edge of the cup should be right about at the same level. Then you have a shallow pullback, and that third peak, which would be the right hand of the handle, all of those should be fairly consistent. You can have them slanted, but I have not found that to be a really effective pattern. And I don't think you really want to call that a cup and handle pattern. The idea is resistance. We trade lower in a big rounded bottom. We come back and test that same resistance level. We fail to break out, but it's a much shallower pullback. And that break above the neckline or the rim of the cup is the real buy signal. So if the left end of the cup was actually down here, I could see the argument. The only problem I have with this is more of a V bottom. It doesn't look much like a cup and more like a narrow something else. So, again, the cup and handle pattern is really designed to look a certain way. And the key part is that the resistance level, the top of that pattern is fairly flat. This one, not the case. That's why I would probably not label it that way. I've labeled Tesla, by the way, more of a symmetrical triangle or a pennant pattern of lower highs and higher lows. And I still would argue breaking above there and certainly above the 200-day moving average would give a nice bullish feel to that chart that we don't have at the moment. Next question. Can you mention some tickers of safe securities that earn interest instead of holding cash in an account? Really interesting question, and I love the fact that you're looking at things like that and trying to come up with better places to be. And this is something I've talked to a lot of financial advisors about, and certainly individual investors. So I'll again, standard disclaimer. I'm not recommending any of these things. Please make sure you do due diligence and do your own analysis or consult a financial professional for particular trades and particular positioning that you want to make. But I'm on the board of directors of a music school called the Walden School, based in New Hampshire, and part of what we're doing is looking at the financial, situation and thinking about how we're allocating and making sure that the endowment that we're trying to start is able to grow. And what I'll tell you is we've looked particularly at this issue. So other things, right? So the challenge with a lot of brokerage accounts is they put you in like a sweep account or some account that is a fairly low yielding thing. And now that interest rates are high enough, you should, cash should not be a zero sum thing anymore, right? I mean, you should be able to get something for someone holding your cash for you. So things that come to mind that I know are used for something like that would be like SHV, which is an iShares short-term treasury ETF. BIL is one that I've seen used very common, which is sort of a sector spiders, an S&P spiders version of that with short-term T-bills. SGov is another one, which is a very short iShares ETF. If you look at these on a total return basis, which is basically what we're doing by adjusting for the dividends, you can see they're accelerating to the upside because you're basically getting an income component to these. A while ago, holding treasury bonds, just like a savings account, was giving you kind of nothing. So we got very comfortable with the fact that you didn't get much when you were holding cash. It was kind of just you weren't losing anything. Now you're actually able to get money from CDs and other products like that. So again, not a recommendation of any sort, but I would be exploring ETFs and others that have a decent yield component that are basically giving you exposures to different parts of the treasury curve. And of course, direct investment in treasury bonds is also an option as well. So I think they're definitely compelling options, and certainly look at accounts that you are owning and make sure that you're getting a decent income on the cash that you're holding there. Next question. If we are in a recession, I don't know how much of an if that is, but I get your question. Thanks for that. What assets or sectors are the best investments? Thank you. Great question. And my conversation with Tony Dwyer really talked a lot about the dreaded R word, recession, the potential for that and what that means. And a number of my conversations with guests in recent weeks have sort of revolved around things like that. So what to think about? I would say that the general things that you would probably assume would do well in a recessionary period would be defensive sectors, right? Things that even if the economy is not growing, if the economy is shrinking, if conditions are bad, what are you still going to probably spend money on? It's not going to be luxury goods. It's not going to be travel. It's not going to be new clothes. It would be things like household goods and toilet paper and alcohol and tobacco, which is what consumer staples, the XLP sort of gets to. It will be power and water and things for your house, which means utilities tend to still do pretty good. And then healthcare, because if you get sick, some people, of course, avoid going to the doctor, but it's usually not about a financial thing. Hopefully, if you get sick and something happens, you're probably going to get that addressed. And so those are generally considered sort of those things. Think of things that aren't discretionary, whenever kind of purchase, like when things are good and I have extra money. What are you still going to spend money on when you don't have a lot of liquid capital around, when you don't have a lot of money to spend? What are you still going to spend money on? Food, shelter, the doctor, medicine. Those are the things that tend to do well. And so those are the sectors that would probably be pretty resilient, which is why it's interesting that consumer staples have been outperforming consumer discretionary, that utilities have been doing pretty well versus the S&P, and healthcare, as we talked about with Mark Newton this week, pretty decent place as well. Finally, I'm looking for the Bloomberg Commodity Index, currently around $100. Is there something similar on StockCharts? Yeah, so the Bloomberg Commodity Index, I know from being at Bloomberg earlier in my career, I know all about Bloomberg's indexes. And the Bloomberg Commodity Index actually used to be the Dow Jones AIG Commodity Index. And then it was the Dow Jones something else, UBS, I want to say, Commodity Index. Yep, Dow Jones UBS Commodity Index. I jotted it down over here. There is an ETN, so it's not an ETF. It's an ETN, an exchange traded note. So similar structure to an ETF. So, not my favorite products only because ETF like products that aren't ETFs, a lot of times they're doing something that's a little unique, and you certainly want to do your due diligence on anything like that to make sure you understand exactly what exposure and what structure you're participating in. So not as an investment idea by any means, but as a way of tracking the Bloomberg Commodity Index, DJP is an ETN, an exchange traded note that tracks very closely that performance of that particular index. I will tell you though, when I set up this chart beforehand, a lot of times people ask me about the Bloomberg Commodity Index, the CRB Index, the DBC, which is the commodity ETF. We usually talk about the GSCI Commodity Index. These are all different indexes that track the commodity space. Here is the DJP over the last 2 years. And at the bottom, this is the rolling monthly correlation between this Bloomberg Commodity Index and the DBC. You can see it's at 0.99, which is basically the same. The GSCI, which is basically the same. And the CRB index, which is basically the same. Randomly, you will find the correlation sag. For example, in late November, they came off a little bit, but they very quickly came back to a strong positive correlation. The weightings in these different commodity indexes are a little bit different. So, for example, I think the CRB index or the GSCI index, it's probably 50, 60% in energy, while the Bloomberg Commodity Index is probably more like 20, 30%. So a little less energy. But in the end, how much does that really change the configuration of these ETFs? Not a ton. And that's why I tend to use them a little more interchangeably than probably others would imply are okay to do. And I usually use the DBC because it's a very liquid and pretty decent ETF tracking the space. But that's how I would analyze the Bloomberg Commodity Index. And those are some of the other options to track commodities as a whole. And folks, that's it. The 3 and 3 is on deck now. Let's go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. When I'm looking at leadership, when I'm trying to take a step back here on a Friday afternoon and think about what we've learned this week, I'm struck by the fact that overall the FANG stocks still look pretty good. However, there's a bit of a differentiation happening that I think has become exaggerated through the course of this week. A couple of the FANG stocks, or what I call the phenomena stocks, in the communication services sector, particularly Alphabet, which is the top panel on this chart, and Meta, which is the bottom panel, both making a new swing high, making a new closing high for the year today. So a nice strong move and nice follow through. Not all the FANG stocks are doing a similar thing. For example, Nvidia, Netflix, others pulling back a little bit. The strength in this market year to date, I would argue, has been driven largely by the strength in the mega caps. That continued trend is something certainly to watch. And whether there starts to be a differentiation where some of these are working and some of them are not would be a very different feel than what we've seen, where pretty much all of them have been working. Watch these to see if they continue to be leadership, and that's Alphabet and Meta. Chart number 2, Wells Fargo. This is one of the many financial stocks that reported earnings here on Friday. Again, more coming next week, and earnings season sort of starts in earnest next week. We get a lot more earnings data to break down with some of my guests. We'll talk about some earnings-related ideas from a technical perspective. Wells Fargo, again, what's interesting about this chart is it's bounced off of the lows from late March. And again, that lines up pretty well with the low that you had in the summer of 2022. But how bullish does this chart really look? The concern I have, or I guess the reason why financials I don't think are a fantastic idea from a technical perspective is because they're bouncing off the lows, but they're not good charts by the general definition I would use, right? Below moving averages, the relative strength not really strong, underperforming. And while we've bounced a little bit in the short term, I'd need to see much more from a chart like Wells Fargo to feel that the trend has now truly reversed to the upside. Some of them gapping higher today, like Citigroup and JP Morgan, others like PNC, like Wells Fargo, not so much. Chart number 3 in the 3 and 3 is the TLT. We talked about bond prices in our Wrap the Week segment earlier today. Again, when I'm thinking about stocks and bonds and stepping back a couple steps from my monitors, really thinking about the trends, I would say sideways is the way that I see this trend. I think the TLT at some point is going to break above 108 and or break below 98. And I think that will be the signal to watch. It is not happening yet. Folks, that's a wrap for this week. I want to thank you so much for hanging with us as we do the show remotely this week. We'll be back in the studio on Monday. All of our great interviews can be found for free at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great weekend. See you next week. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.